Good evening, all. This is Shay Horowitz, ShogunTrading.com. This is our second video in the series about going short on the market, how to use different instruments to take advantage of the short side. The first video we talked about stocks, about how to short the actual stock. Now I'm going to talk a little bit about options and how to use options in order to take a short position on a stock. Now, here's the chart of the S&P 500. This is a 60-minute chart. You can see basically where we put support at 800 and how we went short, and we went short all the way and so on. That's fine. Now, let's say that you want to go short on the market, but you're not, you don't want to go individual stocks. You want to go on the short on the market itself, or the stock itself is not available to short. So you go for the option itself. Now, there are call options and there's put options. Without getting into the actual options, because that information is available all over the internet, basically calls are bullish, puts are bearish. So if you are bearish on the stock or you're bearish on the index, you go for the puts. If you're bullish, you go for the calls. Basically, calls and puts are just insurance contracts, and that's all you're trading is just insurance contracts. So I'll start off with let's start with the spiders. Spider sounds like a great idea. Spiders are basically it's an ETF. It's an exchange traded fund on the S&P 500, and it basically mimics it 1 to 10. If the S&P 500 is 800, the spiders will be at 80. But regardless, we'll put a line over here at 80 because that was the support line that the market broke, and that's when it fell apart. So let's say that your bet is that the spiders will go below 80. 80, if you go short at 80 down to 68, that's $12 profit, right? Okay. Now your other option, of course, is to buy the puts. And what we do, and we wrote an article about puts, about how we use calls and puts, it's on our website, is basically we use ones that are slightly in the money and the next month or the month after that, and that's it. That's basically what we use. We use the options themselves to replace the stock purchase itself. So at this point it will be the 80, but since I don't have 80 on my screen, I'll use the 72. And you can see this is how the option itself trades. And you can see, let me go back to spiders. Spiders broke around 217, right? And these are the 72s, and there's 217. 217 is right over here. So this is basically your entry, and you can see how from 272, from around the $2 level, it went all the way up to the $6 level. So you basically tripled your money by buying the put on this specific index, the spiders. You only had $2 worth of risk, and you were able to triple your money, which was very, very nice. We'll take an individual stock. Let's do MGM. MGM is a stock that I referred to in our last video, in the video about shorting stocks themselves. Okay, so this one went from around the 788 all the way down to the $2 level, and we'll do basically the same kind of exercise, and we'll do the 7.5 put. And you can see how the 7.5 put went from around the dollar level all the way up to 550. Let me make sure that I got the dates correctly. This one started in the beginning of February, and here's this one. So right around here. So right around $1.50 all the way up to $5.50, which is not too bad at all. It's a $4 profit on a $1.50 stock. So there's no longer an issue with stocks not available for short, and there's no longer an issue with the uptick rule. If you can just buy the put option, who cares about the uptick rule? Is that going to change what we do? It's not going to change anything. We can just buy the put and enjoy that. Let's look at AFL. That's Aflac, and from 217 and from the $20 level. So we'll take the $20, and I'm just using the March options right now. So 213, it was around the $250 level, and it went all the way up to $920, which is tremendous. At any point in time, your maximum risk is 100% of your money on options, of course. But if you're buying a $2 option, I don't care if the company gets bought out tomorrow. I don't care if the company, if they release any kind of news, that is your max risk, which is a beautiful thing. Because if, for example, let's say I trade 500 shares of Aflac, that was my plan. My plan was to short 500 shares. I can instead do just 5 contracts of the put, and that's my maximum risk. I take basically a much smaller stop loss on the same number of shares because I'm able to control that many shares through the option. So this one went from the 250 up to the $9 level. It's a tremendous amount of profit. It's a beautiful thing, and that's the power of options. Now you can do them on more. We can do CVT, right? Is that the one? No, that didn't work. Let's do TXT. I'll show you another example. TXT broke around the 224 from the $6 level. So we'll use this one. And you can see how the stock, the option went from the 220 all the way up to the 388 level, which is of course a tremendous type of move on these options. Anyway, I hope I made the point of exploring put options, and I really suggest going straight put options. I don't suggest going spreads or anything along those lines. It's just not useful. If you use an option scanner, for example, you'll see that individual options, you buy the put or you buy the call, are actually more powerful with a better delta, with a better return, with a better risk than anything else. If your stock picking is correct, if you're able to pick stocks, and that's what we do, if you're able to pick stocks, then going for the straightforward, simple options is really the best policy. It works the best, and it gives you the best risk-reward ratio. Anyway, hope that helps out. Our next video is going to be about ETFs and how to use ETFs to go short on the market. Take care.